Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. Roll top wire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. But the markets are freaking out and you don't think that anything is wrong? Put it back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Hey, I'm a little bit late. Listen, daylight savings time sucks, okay? But that's okay because the Senate passed the bill and it's going to go away. So let's go into the charts. We do have some important news coming up here that I think I need to go very quickly because we got core retail sales. Okay, so just really quick, we'll come over. S&P 500 is up both because there have been some positive comments on peace from Russia, which I don't think I think you should just ignore. I don't think that those really match up with what's really going on. Market keeps overreacting to those things, but also we saw some capitulation from China, like coming in and bailing their markets out once again. And that's a big change. So I come over to the treasuries. They continue their downward lurch. Yesterday, after we left, they went another 5 basis points, which is really crazy. But we are getting a pretty heavy pushback here today. And I have to say, with the degree of this move, I mean, there's one side, there's the consistency, like this whole thing over here, and maybe people are trying to price in things correctly, but there's got to be like some sovereign wealth funds and stuff coming in here and selling this, because this is just relentless, big time selling, and it just doesn't stop. Coming over into oil actually kind of pausing here a little bit. They broke, kind of over here. Let's see what happens. At the moment, it kind of looks like oil might come back down to 90, maybe even 85. Gold and silver kind of, I don't know. Gold and silver may not have to go completely with oil, but you can really see the whole commodities complex kind of move together. Like there was a really big systemic move over into commodities, and then they all systemically left it. So yeah, we got Bitcoin. Bitcoin continues to have like these little spikes up and down that are immediately faded. So it's like somebody's trying to start something, but it's not really going. Maybe that reach of 4K. I don't know. And the dollar coming back. So a lot of the risk off sentiment is coming out of the market. But for us here today, we've got Canadian CPI coming out here in about a minute and a half. Retail sales month over month, we're looking for a reading of spot 4. And then core retail sales, spot 9. So that's ex autos and so forth. So let's see where we're at. There's somebody new in chat. They want permissions. And I'm like, I have to read here. This guy sounds kind of funny. I'll give him permissions. All right. I'll move this over here. 30 seconds. Dude, I'm sweating here. I'm telling you. I just did not wake. I did not sleep well. It took me longer to get ready than it should have. Just not my best at the moment. That's okay though, because it's FOMC day. I don't necessarily want to be trading at all today. So for maybe retail sales, we might get something here this morning. Let's see what they do. They're really pulling for this news, to tell you that much. Look at the micros. Good grief. Good grief. Okay, so retail sales under expectation. Core retail sales very under expectations. Whoa. That's a really weird setup. I think that here you could see yields decline a bit. You appreciate the market update. Thank you, Rob. That okay, so just the US retail sales month over month was spot 3 versus spot 4. But core retail sales month over month was spot 2 versus spot 9. So wow. That's a really big divergence there. Like that must mean that overall sales were very much down, but autos actually outperformed. I think that's the only way you could get that difference. Very bizarre retail sales. Hmm. It's this treasury market has just been really volatile, and a lot of the times when you're going into the FOMC meeting, the volatility decreases, and that just hasn't been the case. I'm really wonder. It's going to be extremely interesting when the next foreign holdings report comes out. You know, they got that report that comes out once a month about how much treasury debt different countries hold. And I'm almost certain that a large portion of this has to be those sovereign wealth funds. Liquidity extremely pathetic here, man. Only putting up 500, 700s. That's not a market that I want to trade, guys. Hmm. I'm thinking about maybe trying to do some programming, but I don't really know what I want to change on this thing. Now, let me show you the little what I'm thinking about right now. Okay. Let's see. I did put it in strategies, right? Oh yeah, so it was buy low, sell high. That's what this was. That's what the objective with this one was buy low, sell high. So on this one, I came in and I said, okay, if we are high, and the way that I'm determining what high is looking at the range. So I'm looking at a time period and say like 90 minutes or however far back you need to go, and say what is the high and low of that time period. Not that bar, but like a larger time period, right? And then if we're within a certain percentage of that high or low, and so that's why I'm finding what the range of it is, and then I look at, so the high minus the range times margin. So how close to the top I want to go. Is that 5% or whatever the deal is, right? And I'm seeing a lot of trend. Then I go along and vice versa on the other side. And when I went through and I did this strategy, I actually was able to get something that was profitable over 5 years. and had a had a pretty decent equity curve, but the Sharpe ratio was just awful. The Sharpe ratio was just awful on it. It was like really low. It was like 0.2 or something like that. I've had some other ones. So I have another one that I've been working on that is here I'll show you. Which one was it? It was I don't remember where I put it. I don't remember where I put it. I think maybe I made a new cycles. Yeah, that's where I did. This one was based on using market cycles, a pretty long range moving average, and the degree of autocorrelation in the market R2. That one works, and it works a lot better. This one I think you should be able to get more out of, but I've found, I don't know if this particular Fourier cycle indicator is like the best way to do it, but there is some edge in the cycle thing. There's some edge in the cycle thing. There's some edge in autocorrelation. But it doesn't seem to do better than it doesn't seem to perform better than a strategy that's just buy and hold, right? Anyways, so I got this. Well, so yesterday there was this person on Reddit that was arguing with me, and their whole strategy seemed to be waiting for a breach of a major high or low and then trying to trade that, right? And I think that we have a lot of reasons to believe that this sort of a thing won't work. It actually sounded like what he was doing was he was waiting for a breach of a major level and then trying to fade after that, which is kind of weird. If you have a trend, then that's just going to destroy you, right? So, like, for instance, as an example of the trade that he was giving, he's saying that he was long oil at this point, which I don't know. What do you guys think? You come over to this chart over here. Okay. Do you want to be long oil right now? Well, I'm not really sure I can say where it's going to go, like, in the immediate future. But because if the Ukraine war heats up again and geopolitics and everything heat up again, it could probably go up. But if they don't, then the trend will probably continue, and we could come back all the way to 85. It's kind of like fundamental price that you might see us go to, you know? So I was like, it's a really risky play. You know what I mean? Anyways, I got to tell you this guy. Oh man. He must be a child. I'm like dead serious. I think that he's 14 years old. Because I was coming in and I was like, well, here's like the empirical data that we have and why that empirical data would suggest that this sort of a thing doesn't work. You can't just go and pick arbitrary statistics from the market and expect to be successful long term. As a retail trader, because the market arbitrages those kinds of inefficiencies out extremely well. And prices are inelastic. So if you're kind of trying to base your whole strategy off of some previous price, is probably not really going to matter much, because what matters is the number of orders that are going to come into the market, right? And I explained it. I thought that I was explaining things pretty thoroughly, and the person that was originally posted the thread was kind of asking questions about it, and I give them answers. I don't know if they always like the answer, because the answer is kind of like, oh, it's not, don't use technical analysis, you know? But this guy that was arguing with me, man, wouldn't leave it alone, and really even started to mock the research. He's like, well, okay, so what if some researcher says something they're not actually trading? Why should I listen to them? And I'm like, oh, well, okay, because this researcher co-founded the most successful strategy management in the world, you know. one of the most successful in the world of this sort of thing that we're trying to do. Like, holy crap, man. maybe you should look up who you're talking about before you run your mouth. And it really turned into he was attacking me. It really turned into he was attacking me. He's like, when was the last time that you took a trade? Um, this he was, well, why don't you ever show how you're trading and this and that? And it's like, well, first of all, I shared with you the underlying basis behind my trading, but like I didn't say anything really. I haven't responded to him yet because I'm sitting here like, okay, if you realize that you're talking to the creator of YouTube channel that has all of his trading available online and tons of videos that explain how he does his approach and everything like that, you wouldn't be saying this shit. But I think he did go back and look at my profile, but clearly not far back enough. It's just, oh man, I've never come across somebody, and here's the thing that's funny is when I go back in his post history, like you go back 4 months ago, and he submitted something to the subreddit that was, I finally feel like I'm starting to become consistent. So it sounds like he's been doing it for a while, but he says, I finally feel like I'm starting to get consistent. And the post that he had was basically like he had won 3 days in a row. Right. And everybody in the thread is telling him, well, that's really not enough to judge your performance on. Right. So like this guy already has a history of, making these big conclusions off of too small of a data set. Right. And so I'm coming in and telling him, well, you need more data than that. Like, what is the 5-year expectancy of your strategy? You don't know, because you don't know how to even calculate that sort of stuff, right? So you go back and look at his history, and it's like he's only been trading well, I think he's been trading for a while, but he's only been successful with this for like 3 months, which is like, yeah, you're gonna blow up here soon. We've seen this so often, right? But I've seen a lot of people come in with that sort of a thing, because here's the thing, like I know I'm ranting here. I see your comment, Oceanic. I'll cover that here in a second, right? What you're gonna see in the trading community is that the people that share information very typically are going to be misled, because what you're gonna see is this. On one side, you're gonna see people that are successful, right? But their success might be luck, probably not reproducible by you, because there's generally going to be something very specific to them that allows them to do that, So it generally is going to be really hard to duplicate. And if it's like a technical analysis kind of strategy sort of a thing, they're not going to share it, because sharing it would ruin the edge. And I mean, if they're really smart enough to be like successful over a 5-year period with that sort of thing and have a good Sharpe ratio, yeah, they're not going to share it, right? Okay. Then on the other hand, you have the people that are very consistently unprofitable. Okay. And you're not going to hear much from these people, because these people usually quit, or the very few that are really, truly persistent and stick around for years and years and years, realize that they don't really know what's going on, and that most of these things don't work, right? So you don't really hear much from them. So the people that you're going to see that are going to talk are going to be the ones that get enough success to think that they're all that, and then blow up later. And so you'll hear from them when they have the hot hand, and then when they blow up, they disappear, right? That's what you're going to see in the trading community over and over and over again. So just realize that the strategies that you see out there that tend to be popular tend to be streaky, is what I would say. And that is very much the case with price action strategies, because that's really what I would consider this guy doing. He's waiting for a breach of a major level and then trying to do something after the breach of that major level. And you're going to see the market go through periods where that works really well, and then go through periods where that doesn't work very well at all, right? And they're not going to realize it until it's too late. That's what typically tends to go up. It's a 14-year-old blowing up. It's not worth it. Well, you see, I didn't respond to him, so I don't. I don't know if it's worth responding to him now because he's clearly not going to listen, and I don't think that anybody else is really reading the thread anymore. Holy crap, man. It was just like he has to be a kid. If this is a grown adult acting the way that this guy is, I can't even. Because some of the language and stuff. So one of the other things that he said that I thought was really funny was I was saying, okay, like here's some studies and here's some empirical evidence to confirm a type of market behavior that very much contradicts what you say, right? And he's like, so what do you have? Do you have evidence that can you prove that that thing actually happens? And he's like, you're asking me to make a study about whether the sky is blue, is what he said. And I'm like, okay, but there are studies about the sky being blue. There's a lot of studies about the sky being blue. They weren't really sure why the sky was blue. There's all this research about the properties of light and the material in the atmosphere and everything, and how that results in the sky being blue. Right? Like the example that he picked is like the perfect example of like why empirical research is so important and useful. Is because guys, when you're talking about a trading time period of like 5 years, okay? Picking out some sort of statistical irregularity in the market over the course of 5 years, you cannot do it from just looking at it. You can't, because you as a human are not able to look at that much information at a time and be consistent about it, right? You really have to analyze these sorts of things algorithmically some way and do like a real study to say, okay, over the 5-year period, every time that this situation happened, here are the outlays that come out of that. What thread are we talking about? Oh man, I can't even remember the name of the thread, but and I don't want to give it to you because I don't want to be like brigading, right? But the what prompted the thread was somebody was using, I think they were using an RSI strategy, and they took a big loss from it, and they're like, well, it didn't work this time, so what am I doing wrong? Have you ever seen those threads? Oh man, it's always such a shit show because you have a bunch of people who say, "Well, but you look at this indicator and this thing, it would actually tell you to do this." And everybody has an opinion about what kind of technical setup you should use instead. But then there was somebody that came in and said, "Well, yeah, this isn't going to work because it's just technical analysis mumbo jumbo, right?" But then they said, "Well, you should use price action," and so then I came in and said, "Well, you're just trading one form of trash for another, right?" And so then I got into market inelasticity, right? Whenever we talk about consistency over long periods of time, are you just talking about K ratio? So that would be that would be like more advanced than even what I'm talking about, Alex. Like here's what I'm saying, okay? Over a 5-year period, are you even making money? How consistently are you making money? Like that's just the first thing. Like that's just the first base, okay? And then are you getting a Sharpe ratio over 0.5? Okay. If you're not getting a Sharpe ratio over 0.5, then you really have to question if there's any point to you trading it, right? Actually, let me put it this way. Like you could trade it as a hobby, okay? You could trade it as a hobby and you'd make money and you'd be able to keep trading that'd be fine, right? But in order, if you were going to start a fund or, you were going to manage other people's money or really go anywhere with the strategy, it has to be at least over 0.5 and really should be over 1, frankly. Could you explain Sharpe ratio? Yeah, and then I need to get to Oceanic's comment. So essentially what a Sharpe ratio is how consistent are your results compared to the risk-free rate of return. So it's basically it's your results minus the risk-free rate of return over the standard deviation of your results. So if you are getting a Sharpe ratio of 0.5, that is like what buy and hold on the S&P 500 gets you. Okay? So the standard index performs 0.5. Okay? Now, once you get 0.1, once you get over 0.1, what that essentially means is that there is an edge beyond just the amount of risk that you're taking on, right? So you could have a strategy that's really, really successful, but is taking on a considerable amount of risk in order to make those profits. And that's when you're going to get low Sharpe ratios like below 0.5 or even negative. It's possible to have a negative Sharpe ratio and still be profitable, actually. Okay. So that's what that all means. Okay. Once you get over one, then that means that you have an edge over just the risk that you're taking on. Okay. So really, when we talk about risk adjusted returns, a strategy that has edge in risk adjusted returns is going to have a Sharpe ratio over 1. Okay. But Sharpe ratio is also has flaws. Okay. So that's why I just say, like, that's just where I kind of start, because nobody ever is even beating those metrics. Once you get into the fund world, because it's so hard to really get a strategy that has a Sharpe ratio over 1, the people that do get their strategies over 1, there's other deficiencies that they usually have, and that's why there's all these other kinds of ratios and stuff to try and judge your performance by. Okay. So now, Oceanic. Do you base your market context reading on market profile as well? Not really. So listen, when I go through the charts in the morning, it really is as simple as what I tell you guys. Okay? Like, I will analyze the S&P 500. A lot of people would come in and they would say, okay, there's this spot and there's this spot over here in the profile, right? Where's my pen? Let me get a drink of water here. Okay. So most people will say, like, if you go to Future Trader 71's profile, and I'm not bashing on the way that he looks at the market, but I haven't been able to find any evidence that this actually works. Okay. They come in and they say, look, there's a bump in the profile there, and we're opening above that. So one of my scenarios is going to be that we're going to revisit that previous day's point of control and then maybe bounce off of it and move lower. And maybe another one of them is, and that lower target will be here and below, maybe. Right? That's the sort of thing that they say, right? Here's what I say. The reason why there are stats that will say if we open above the previous day's point of control, we're likely to come back and revisit it, and that if we come back into this profile and we're there for a certain amount of time, then we're like X% likely to touch it, and that sort of a thing. These are really all statistical aberrations that are just created by volatility tendencies, right? The volatility today is likely to be pretty similar to the volatility yesterday. So if the volatility yesterday was able to move us up this much, then the volatility today is going to be able to move us this much. And that means that there's a really likely chance that you'd be able to touch this right here, right? But it doesn't really give you any kind of profitable expectancy, because you don't really have a edge in determining which way it is going to go from that, right? And you don't really need to see the market profile to be able to judge how far it's going to go. But like, here's the thing. Why does volatility do that? Why is it kind of consistent from day to day and kind of why does volatility cluster? You have like a period of high volatility and then it calms back down. Why does that happen? Well, I would argue that it is largely a function of the liquidity and the orders that are placed, right? The liquidity conditions that you have in the market right now, especially in the treasury market, there's not very much liquidity, and that's why it's moving so much. Okay, so you really don't need to see those things to know. Really, you can come over and you can look at the things that actually matter, which is the liquidity and the orders. Okay, so what do? I come in and I say, okay, last time I looked at the chart, we were here, and now we're here. So we're higher. Why are we higher? Okay, and when did we move? Right here. Okay, well, there was a piece of news here. What was the piece of news here? There was a comment from Russia that was interpreted by the market as positive, that they were seeking peace in the Ukraine war. That's why the market moved up. Now, when I look at the piece of information, doesn't look to me like it really means anything to what they're saying. Here, let's come and look at the piece of news so I can try and explain that, because I think that's kind of does end up being kind of an important part of what we're talking about here. Where was the UK? Okay. So Zero Hedge kind of explains my position really quite well, right? Russia sparks ceasefire hope after Kremlin says neutral Ukraine with army could be a compromise. Okay. And then they say at the same time, the Kremlin cited potential opening towards peace on the ongoing ceasefire negotiations. Following President Zelensky's insistence repeated Tuesday that Ukraine must recognize it will not join NATO. Apparently, sizing up on this as a key point of compromise, which has from the start been foremost among Russia's security demands to NATO, Kremlin spokesman Dmitry Peskov said on Wednesday the proposal for Ukraine to become a neutral country could be viewed as a certain kind of compromise, as quoted as Bloomberg, right? Bloomberg noted Peskov declined to provide details beyond confirming the idea of Swedish or Austrian-style neutrality is under discussion in the talks now underway in Ukraine. This appears to have gained traction at the negotiating table, given that Bloomberg is reporting simultaneously the words of Ukrainian President Advisor I'm not even going to try and pronounce that name, who was stressing that any future model of neutrality must safeguard Ukrainian sovereignty with firm security guarantees. Yada. Despite this clear opening at the negotiating table based on neutrality, the fact that Zelensky has been pushing a no-fly zone hard in front of an international audience and on Tuesday doing so in a virtual speech to the Canadian Parliament could greatly complicate things with Moscow in terms of finding a possible diplomatic off-ramp. So even though they're saying this stuff, like everything else that they're saying kind of suggests that this is going to keep going, right? It's just not enough information for me to come in and be like, oh yeah, I totally want to buy this, okay? So, but that's the main reason for what we're getting here. That's why we had this move up, okay? So I'm just going to ignore this move up, right? What matters from here? What the future orders are going to be. That piece of information isn't enough for me to say that the future orders are going to be long. Have the Russians put boots on the ground in Kiev yet, or not really? No. They broke the column up, and the Russian soldiers are kind of surrounding Kiev, but they are still extremely bogged down, and as such, nothing has really happened. We might see a switch where the Russians start to focus more on the south and trying to take Mariupol, but right now the Kiev thing is just at a standstill because of that. So. The market has a whole lot of prices again. It's like an auction. No, not really, actually. But let me visit that in a second. Okay. Anyways, so when I looked through the charts, I just want to know what happened overnight. Why did the market move? And then I'm also trying to sort out based on the news, like what is likely to be the sentiment today, because sentiment is a really big factor behind which direction the orders come out at, right? And then I'm going to be looking at, okay, what kind of news do we have? What kind of like, are we at the end of the month? Where are we at on the weekly cycle and those sorts of things? There's all sorts of determinants of order flow that I can use in kind of a fuzzy combination of sorts to determine if I have a really good edge in predicting whether we're going to move up or down today. And there go if I want to favor a direction, essentially. So that's all I'm doing there. Okay. Now, when it comes to market profile, you know what? There was a bunch of activity there. If we move down, wouldn't surprise me to come back and see 42.20, but I really don't care too much about it. What I care more about is how many orders are going to come. That's the question that you really got to ask yourself: is how, if we do get a move up, let's say that we have a move up further, okay? Another way to take it on the other side, if we move up, there's going to be a lot of people watching for like this breach of 43.27, right? Like the guy that we were making fun of, right? He's going to want to see a break of 43.27, and then he's going to try and fade it probably, right? But I don't look at it like that, because I'm coming in and I'm saying, how many orders are there going to be? If the Federal Reserve comes out and something that he says makes the market believe that the Federal Reserve is not going to be as aggressive in hiking rates as the market currently believes that they will, then what you're going to see is the market is going to rise. The number of people that are going to trade off of that headline is going to be way more than what that price level is. And anybody that has any kind of a stop or is, trying to take a reversal in that trade is just going to get smushed. Right? So that's how I look at it. Now, going back to the TLA trader's comment, right? The market visits a lot of prices again and again. It's like an auction. So the auction theory of things is that there is a price that is considered fair value by the market participants, and that's why there's a lot of volume there, which doesn't really make a whole lot of sense to me. If you think that the price is fair, why would you enter into a position? But just ignore that for now. Okay, they think that there's a price that is fair, but there are people that will come in and they will try and move price away from fair value. So they will auction up, and they will auction up until price gets too high that nobody wants to buy it anymore. And at that point, it will then either settle at a new value, or if the value hasn't changed, it will eventually revert back to where it was, right? And that is auction theory. It wasn't a bad theory. I mean, it was certainly created by people that actually trade. I tell you that much. But it's not actually true to how the market moves and why. Okay, those prices where there's a lot of activity, man, these treasuries are just getting like destroyed again today. They're starting to look like we're just going to have another really big monster move in the treasuries again today, based on all the news that we had this morning and everything, and the prices that we're at. I'm not sure I see a whole lot of reward in it for me to take the risk on this kind of a trade. So I'm just kind of let it do its thing. I'm much more interested in trading it like tomorrow and the next day. I digress. Okay. Why does a lot of activity happen at those prices? You don't trade it if you think that it's at fair value, guys. You trade it because you think it's below fair value, or you think it's above fair value, right? So really the reason why those prices happen, why you get like a lot of people traded at 15.5, it's actually really just kind of chance. Like there's a situation where a lot of people want to trade it at that one exact moment. And because so many people traded in that one exact location, there's less liquidity there. And that makes it more difficult for price to get outside of that range. That's what's really happening. Okay. Normally, the liquidity is like this, right? And then when a bunch of people trade in this location, you get a hole. So then you get something that's kind of like this. You get a hole like this. Because the people in here were executed. The people outside here weren't executed, and there's new orders that come on, but there's not going to be as many new orders in here as there are over here. And so it will require more market orders than usual to get away from this location because of the aberration that we've created in the liquidity because of so many people trading quickly in that location, right? And that hole you can then be in that hole for a really long time. It will build up a ton of volume. It eventually becomes the point of control. But it wasn't because anybody thought that price was significant. In fact, it's actually kind of like they didn't think that it was significant. They all wanted to trade there. That's kind of why it happens. Okay. So then why does the market move up or down? It's not because somebody's trying to move value or anything like that. It's because there were market orders. There's some sort of large meta order, whether they had a reason to trade or not, that moved the market up. And how far up it goes is completely dependent on how large that meta order is and what the liquidity looks like. Okay. And whether it comes back or not, again, completely dependent on the orders. Okay. If it moved up and there was no informational content in it, and it was a really fast move, pretty good chance it comes back just because you leave this wake behind you, right? So there is kind of a tendency for prices to fold back on themselves because of the liquidity that it creates behind it. That's one thing, right? But you can't come down and say, okay, we moved up and then we pulled back a little bit. We're going to fold all the way back, or we're going to stop there and we're going to go higher. You can't determine that just from looking at the price movement. I have not been able to find any kind of statistical irregularity that gives you any kind of effective outlay, or say like a positive expectancy trading just the movement. The whole ideas behind price action is just kind of silly, right? What the current price is, not very effective at predicting future orders. Not very effective. So what do? I come in and I look at what are some things that I know that can predict future orders. Okay. So I tell you a couple of things that I know can help predict future orders. Okay. Number one is sentiment. Okay. Yeah. There is some positive sentiment today, both because of the Ukrainian news and because Chinese stock markets got bailed out. That helps you too, right? Okay. Because the Chinese, yeah, what do you think about the Chinese markets nosediving? Well, I think that China has been doing a bunch of things that gave its investors very good reasons to be concerned about their economy. And last night, apparently, they kind of came in and saved the markets and assuaded kind of some of those concerns. So this might be a major turning point for the Chinese markets. We'll see. I think there's still some problems over there. You know what? I think that my child messed with my heat register because it's getting hot in here. Hold on a second. Nope, it's not that. It's just me. I'm just crazy today. Probably because I didn't sleep very well. Anyways, so this is what we know about markets. I don't understand the mentality of a person to come in and say, well, I've only been successful at this for 4 months. And I know that 99% of people that do this aren't very, either lose everything or are just only modestly successful at it. And I know that there are top researchers in the world that say X, but I'm smarter than all of them. And what I know is I'm so confident in what I think I know that I'm willing to make a complete ass of myself online. You know? It's like, listen, I'm willing to make a complete ass of myself online because I have empirical evidence, you know? I get what you were saying, but I don't understand how separate market/assets can move in tandem at times, both up and down. Okay, so that's an interesting piece of the puzzle, isn't it? Because markets do tend to be correlated. So, like, here's the thing: if you're a market maker, where can you get your edge from? Because I'll tell you, being at the front of the queue is an edge, but that alone isn't going to make you profitable, unfortunately. Okay, they have to have more than that. And generally speaking, you still have to have something to tell you this is a good price for me to trade at, right? So you could come in and you could say, what is the fundamental value of this asset? But what do we know? Well, it doesn't necessarily matter. I mean, it does matter, but it's not absolute because orders can come in that can completely contradict what the fundamentals are merely because a fund is rebalancing or whatever the deal is, could move things very, very far away from fundamental value, right? So if you're trying to use fundamental value, probably not going to work very well for you, right? So here's what market makers do is they say, well, here's this related asset. So this related asset it should be like roughly equal to this one. Okay. So it could be because they're the same thing, right? So it could be, for instance, you're trading the 10-year ultra note. So TN or not T, yeah, sorry, you could be trading TN on one side and 10-year yields on the other side. And those should be pretty heavily correlated, right? And if there is if this one moves up a tick and this one doesn't move down a tick or whatever, that's an arbitrage opportunity, right? That's an arbitrage opportunity. But you don't even need to go into there. You can say, well, the 10-year is really the same as the 30-year, except for that the 30-year has longer duration on it. So I can just calculate what is the difference between this one and this one based on how many coupons are in between them, right? And what the risk premium of the 30-year is. And I should be able to, from this one, determine what the price of this one should be within a certain amount of allowance because of changes in the spread, right? And then I could arbitrage the spread, for instance, right? So that's kind of the basis of correlations. That's where correlations originally come from. But there's a lot of correlations that are a little bit more fuzzy, like the correlation between the treasury and the dollar, right? Because if the dollar is going up, the more people want dollars, that often means more people available to buy treasuries. And so the dollar and the treasuries will often stay in correlation, but not always. It can change. It kind of depends on the situation, right? So but then there could be another situation where, like, for instance, because of a change in Federal Reserve policy, I want to sell short-term notes and I want to buy long-term notes. And then you get the 5-year move down and the 10-year move up. And right, that's just a function of the orders that are coming in. And it contradicts the correlations. Right? Well, but if market orders are coming into, the reason that market orders are coming into one market is very likely to cause orders to come into the other the correlated market as well, right? But that's where it kind of gets interesting, is because, like, if you have two assets that are heavily correlated and then all of a sudden they're not correlated, it doesn't necessarily have to be a thing going on. It could just be random because of the orders or, a fund rebalancing or something, right? And so in that kind of instance, the only way in which we can formulate a trade off of that is if we know why, right? If we know that the reason that these two correlated assets aren't moving correlated right now is because it's that time of month or whatever the deal is, right? Then I could say, oh, this is going to be a temporary thing, and then this one is eventually going to come back and catch back up to it. And that's kind of how you can formulate trades at that point. So you just kind of have to come into a point at which you can say, okay, when is this force that's moving it the wrong way going to subside, and another force is going to come in that puts it back in line? And if I can sort something like that out, you might have a good trade set up. Okay, what do you think about fractals? Here's what I think about fractals. I haven't done this in a while. If I come over and I bring my screen over here, right? That's a fractal. Okay, what is a fractal? A fractal is a function, f of x equals y, where x is equal to the y from the previous run, right? So you're going to process this function, you're going to get y, and then you're going to plug y back into this function and do it again. And then you're going to do it again. And that's what makes a fractal. That's what makes a fractal function. So this, what you see here on your screen, this is a fractal function. We're taking the output of my screen and then we're folding it back in on itself, right? Where is... did it not show up? Hold on. Ah, there we go. That's what I wanted. So now when I come in here, now I'm like really getting crazy. Come over here, and then come over here. Okay. If I can do it. Okay, here we go. All right, so now you're looking at my mouse cursor and it's going in and out on itself, okay? You notice anything kind of weird about this screen? Like, what the hell is with this kind of weird anti-aliasing around the edge? You see how it's like distorted the cursor and stuff like that, right? That's just like the noise introduced from the fractal function can do really weird things and frankly kind of unpredictable things. It's like I can kind of tell you that it's gonna look weird like that, but like exactly how that mouse cursor is going to look like, I can't actually tell you for sure. And if I move the cursor a little bit, what is it gonna do in response to that is difficult for me to predict, right? And why is that? Because when you're plugging a function into itself over and over again, you can get very quick and bizarre fluctuations in that system in a fractal function. Okay. So what do I think about fractals? The market is a fractal. The market is a fractal. It is you're doing a function. It comes out with a price. All of the market participants take that new price, factor that into their equations, and it goes in again, and it's doing that around and around and around again, right? But you cannot predict the outcome of a fractal function without doing the function, which in this case would mean trading. We don't have some math. I mean, maybe it exists, but we haven't discovered it yet. Some math equation where we can say the x value of this fractal function is this. You can't do that without running that function x times, essentially, right? And so it's the same in the markets. When you're using the prices being fed back into themselves, you can't really predict what's going to happen very well. That's essentially what the nature of the fractal is, right? But I'll tell you one thing that does really matter for the fractal, right, is what the original picture was, right? In our instance, the original picture was the mouse cursor, right? The picture of the mouse cursor or the background that we had, right? That is the initial input is probably the most key piece of information on the fractal. So what is that in the markets? Well, that's all of the determinants of order flow that I just told you about, right? This is like, what is the sentiment today? What price did we start at? We have an FOMC meeting today. It's Wednesday. A lot of people put money to work on Wednesday, but they're kind of probably holding off because of the FOMC. We have really high volatility. These are all kinds of things that factor into what the landscape is, and then we can go into the fractal thing, right? But it doesn't really help you. And this is just another explanation, another way of explaining why markets are very statistically efficient, right? Because what happens is everybody looks at the way that the market has performed in the past and try and base their strategies off of the past performance. And that means that the inefficiencies that had existed in the past or in the recent past are more likely to get arbitraged out of the market by people seeing it, right? Unless you're able to find a statistical aberration that's really, really deep hidden and like nobody else is going to find it, right? So it's really just kind of another explanation of saying trying to base your trading purely on technical analysis is unlikely to result in long lasting profits. Simply by the very nature of the markets themselves. If they're separate and only market orders really move markets, individuals, well, it's not only market orders that move markets, right? The limit orders have just as much impact as the market orders. Although you will find that the tendency is that the market orders are more influential. It's kind of like the dark side versus the light side, right? It's like, no, the the dark side is not more powerful, but it is more influential, or it's easier in the short term. It has a stronger impact on price, yeah, in the short term. But that doesn't make the limit orders irrelevant or anything. It's just informed traders tend to prefer to use market orders because they want to move the market maker, right? If you're really going to move the market, if you're taking a position, you kind of want to move the market maker to some extent. Uh, on another thing, just remember this like liquidity hole thing, right? You can force those liquidity holes to occur. And that's what a lot of these firms are doing with the way that they execute is that they're going to move the market to create that liquidity hole, and then they're going to be able to get filled within that liquidity hole. Right? Joe Biden's forehead is a fractal. Fractals is a really super interesting science. There was some stuff from Jean-Philippe where he was talking about fractals, and they were saying that they think that they could use fractal modeling to come up with a better model for volatility, I think it was. Really interesting stuff. So we might get more on that in the future. Well, that was like a whole hour of ranting on just one single thing. But I didn't really come to like the resolution that I wanted, because I'm still stuck at how can anybody, knowing what we know about markets, just come in and say this kind of BS? Like, how clueless do you have to be to talk like that? You know? Like, I feel really confident coming in and saying, like, the price doesn't really matter. We've come in and we've back tested stuff. This X thing doesn't really work, right? Well, that kind of brings us back to, can we let's try and make let's try and do a little bit of back testing based around that idea, right? So let's do it. Let's just do it based on daily high and low. Unless you guys got better ideas or there's other things you want to talk about. Because right now, hey, you know what? The market's at a pretty decent like drawdown here in the treasuries, and then they bounced back up again. So yeah, no, I don't think I really want to touch this at the moment. Stick around though. I think there's still a lot to talk about. Let's see here. Oh, I'm pretty sure that I made a folder that was called like price action. Maybe not. Let's just create a folder called price action. Price action. Okay. That's what we'll call it. New strategy. Daily high low. Okay. So to do this one, I think we're going to need to move my microphone down here a little bit. Tilt it up. Yeah. So I can see a little bit better. Add data series. Or actually, no. Let's not add that one. Let's do open, high, low, close, daily, I think is what we call it. What is it called? Is it called something like previous day, open, high, low, close? Prior day, open, high, low, close. Prior day, open, high, low, close. Daily. There are two. Oh, okay. Yeah. Sounds complicated. Okay. If so, how can we say this? Let's do the margin thing, kind of like let's do like a percentage thing again. So, should we just kind of steal some of the code from over here? I think so. No, we'll just do it. I'll just do it by hand here. Double range equals daily dot high. Think minus high of 0 minus daily dot low of 0. Prior day, open, high, low, close. Oh, it's going to be prior. Dot prior high. Is a series, yes. Prior low. Okay. And then if should we do it like, how should we do this? We should wait for the high to be reached, yeah? Which sequence represents America at the moment? I'm not sure I understand the question. I think that you're trying to make a political statement that I'm not too interested in exploring at the moment, to be honest with you. I think that what we want to do is we want to say there's a breach of it, and then we wait a certain amount for it to turn, right? So we should say if the close of 0 has crossed, no, we say if, here's the open, by the way, cross above daily, close, comma, daily that prior high, comma, what should we call this period once? Or we just call it period. And something else. Enter long, or no, enter short. This probably won't work very well on the S&P 500, right? Okay, so coming back to this buy low, sell high. Let's just steal a few things from here. Period, margin, threshold. Oh, we want period. We do want the period. You're having a debate with somebody about America. Eventually, the America's not going to default in the next crash. No. The only way that with the way that things are set up right now, the only way that America defaults is if Congress, fails to raise the debt limit. That would cause them to default. Do I still have the... Oh, yeah, I do. Keep building their house of cards? Well, yeah. But I think that that's a wrong way of looking at it. Like, I think that when we're talking about this sort of a thing, like the way that we want to think about it is like the way that, your household debt goes. Your debt gets too high and you can no longer service it. And so you file for bankruptcy. There's no bankruptcy for the United States of America, right? The US can't just declare bankruptcy. That wouldn't happen. So, if you got to the point where the interest rates were so high and the debt was like a real problem, that servicing the debt was a real problem, and interest rates would have to be a lot higher for that to happen. And there would, at that point, have to be a political solution. Yep. The puppy has been bothering my wife. The British, Dutch, and Greek felt the same way. Yeah, but has the British defaulted though? Like that's I think that the key mistake that you're making in the argument is making the argument about defaulting or not, right? Because yeah, they might not default. That doesn't mean that there's not economic consequences, right? There's economic consequences to holding a high debt level. There's especially economic consequences when you have a high debt level and interest rates get higher, right? So it could be really bad for the country. It could cause a permanent impact to that country's wealth and so on and so forth. But that doesn't mean that they would default, right? I mean, you've seen it here today. Like, here's the thing. In 2008, we had like a big crisis. It was a big problem. We came in and we bailed them out. It wasn't like, everybody acts like we bailed them out and then like that was that and everything was hunky dory afterwards. No, it wasn't, guys. Like, we're still reeling from the consequences of that decision. In many ways, it was good because I mean the markets are still up and we did have a lot of prosperity here. But then at the same time, for instance, home building never recovered. Right? They're still not building enough houses. Millennials can't buy homes. Like there are consequences. There are consequences. Consequence in this case is not that they default, but there are consequences. Okay. And so if we have a cross above the high and okay, let's do SMA trend. Okay. SMA trend. Trend equals SMA of period 2. We're gonna say. Okay. So is falling trend. So we wait for that prior day high to break, and then we start to see the trend turn down. We'll try and take a trade based on calculation mode, close, range, time stop. Okay. Yeah. Let's see here. The market is so aggressive with rate hikes, and I think growth is slowing and will continue slow. Hence, Fed will not be able to continue hiking. Now, that would be an accurate assessment if that's what actually happens. Yeah, it is a really kind of a weird thing. But I think in terms of the 10-year though, I don't think that it's how do I say this? 10-year yields will not be driven primarily by growth, right? I mean, it's an important factor, but inflation is going to be the biggest determinant of where the treasuries go in the future, right? And what we're seeing right now is a possible turning point in very, very large macro factors that I don't think we can even begin to fathom the implications of changes if this really comes through. It really looks like economies are becoming more concerned about the risks involved with the global supply chain and are trying to localize their supply chains again. And a big consequence of that is that things aren't going to be as cheap as they were. So yeah, you're going to see inflation probably, right? So we could continue to see rising inflation even if growth comes to a standstill, right? We could be entering into a stagflationary era. And in a stagflationary era, their tendency is going to be they want to hold back on interest rate increases, but that's what they did in the 70s. They kind of learned their lesson from that one. So if we go into stagflation, probably Federal Reserve keeps raising rates. Putin says we will achieve all of our tasks. We are ready. Putin is speaking right now, so that could move the markets pretty big here. Pretty good up move so far in the S&P 500. I am starting to see a couple of assets move here. Gold and the dollar are kind of moving. The treasury's not so much yet. 6% mortgage rate soon. Dude, I tell you what, if that's really where we're headed, it's a little scary to think about, isn't it? because servicing the debt at, even at like 5%, I think that we're okay. But with that certain point, you really start to get into like BTC is going to explode with a confirmed stagflation. I wouldn't be so sure about that. So again, we got to think about what moves orders, right? Okay. So there's not a lot of real business built around Bitcoin. It's pretty much at this point almost all speculation. Because it's not used as a medium of transaction. There aren't people that have to buy and sell it to do business with it. The only real purpose of it is investment reasons at the moment, right? So the biggest determinant of how much money is going to come into Bitcoin is going to be how much money people have. If we move into a period of stagflation, that's not going to be positive for stocks or Bitcoin. And again, you talk about Bitcoin and risk assets are heavily correlated, like that's what you're going to see. If we go into that environment, you could see a whole decade where both the stock market and Bitcoin like basically go nowhere. I guess Bitcoin would probably still rise generally because of the decreasing supply and all of that sort of a thing. But I mean, come on, look at this. We've had inflation. Just think about the past year, Anthony. We've had record inflation. Guess what? Bitcoin is off of its highs. Bitcoin is off of its highs since the inflation really started to come in. Significantly off of its highs. Stock markets are, especially small caps, are significantly off of their highs, right? Gold and silver are significantly off of their highs. So a lot of these things that people kind of took for granted that there would be certain correlations in an inflationary environment, when you actually kind of dive down into the incentives that create orders, it's not what they thought, is it? Yeah. Sicko says I've accepted that BTC is a piece of junk liquid scam. I'm not going to go as far as to say that it's junk. But rather I'm going to say that it's not what its proponents think that it is, and the current Bitcoin market is based on fraud. With staking, well, there's been some problems with staking though, right? There's been a couple of these staking coins that of like, or sorry, there's not, we're not calling it staking, right? Or they were, you just call it like loans and stuff, right? There's a couple of those that have just imploded. So this is a very dangerous fallacy that because it's doing really well right now, that means it's a good idea. That's what do we have to rate? So this is a really great time to go into the thing that the channel is all about, right? Markets are not informationally efficient. So it's totally possible, in fact likely, that the entire Bitcoin market is based on fraud, that Tether is printing money that they don't actually have, and that when regulation comes in, that it will hurt Bitcoin in a very material way, in a way that could make it very difficult for it to ever recover, frankly, and in a way that could cause a lot of the more speculative parts of the Bitcoin market to just completely collapse, right? And you wouldn't see it in the current market prices because what moves markets? Orders. And there's no reason for anybody to submit orders based on that information, at least not right now. So you can't use the current state of the markets to say that this is a good investment or this is what's going to happen. You can't do that. This is a fallacy. Okay, so I feel like I'm still missing something in this. Okay, so first of all, I need period 2 in here. So I think up here, I want period to be 4. So let's say 30 minutes. Let's do on 5-minute bars and say 30 minutes. And period 2 equals 8. An hour. Moving average on an hour is down. Is that possible? I don't know if you'll ever get that. Well, we come through and do this. It might never work. Okay. Stop equals 0.25, I think. And R factor equals 1. Use stops and targets equals true. See if that compiles. Oops. 2. You know what else? I should come up in here and I should say add in. Now, hold on. Let it finish. I'll see if it'll do the IntelliSense for us. And let me find it. Ninja Trader, add indicator to strategy or something like that. Add indicator to chart strategy. Do I have it in one of these ones? By the way, I appreciate the donations, Anthony. Am I justified in thinking that the open today is non-directional? No, I think it's very directional to the bull side. Could you discuss the S&P movement and thoughts on considering a short-term fade? Well, so I think that the biggest thing that you got to factor, I mean, the biggest thing for me today is how high the volatility is and is likely to continue to be today. That I think is a very good reason to just not trade. Okay. But something that I do think that we have been seeing is that the market has been pretty bearish lately. And I think that we're kind of seeing some like unwinding ahead of the FOMC. So I don't know if this action that we're seeing in the treasuries yesterday and today is really that indicative of anything else. But what really matters is what comes out of the FOMC meeting, and just realize that even the way that the markets move after that might be deceptive, right? Because what moves markets is the orders, and they can be wrong in the short term. Can be very wrong in the short term. Okay. So something like add indicator to chart, something like that. Add chart indicator. There we go. And chart indicator daily. And chart indicator trend. Oh, and you know what else? This is not configured. This is state dot data loaded. Okay. Why do you say really why? The S&P 500 is up 20 points. Is that not enough? Is that not enough to give you kind of a direction on the S&P 500? They think that it's higher. That might be all they get. I don't know. When I come back over here, oh, it's not showing my volume chart. Bitcoin seems to be having trouble with something. Or sorry, Ninja Trader seems to be having problems with something. The volume profile doesn't like. What's the best way to trade FOMC? Probably the best way is to not trade it. I think that after the news release, if you're really willing to take a risk, you can make plays, right? And sometimes there's something in the statement that you can really trade, and when that happens, you can get really monster moves. And if you take the risk, you're really rewarded for it. In that short time period between then and when the press conference is, when you have the press conference, sometimes he'll say something that's like really clear and you can take a trade off of, but that usually tends to be really choppy. Or you can just make a larger bet about the market. You can just make a larger bet about the market, like interest rates are going to rise or something like that. But it's a gamble, right? No, but why I don't care about price? Well, okay. So because it came up to 43.20 doesn't mean that it's going to continue up from here, and certainly not that it's going to continue up from here in the long term, that this is like the high of the day or anything like that. I'm only saying that the initial impulse off of the open was very bullish, and that sentiment today appears to be bullish. But it's clearly more complicated than that because the treasuries have eventually backed off, didn't they? Okay, so like my volume profile finally came back. Yeah, the move that we had yesterday was pretty big, and then now this move that we've had today is pretty big. We're getting pretty close to these levels that are like really long-term levels. It might be interesting to see what people do, but sentiment is probably a really key factor. Yeah, I think so. I think that the headlines coming out of Putin and especially the China stock market recovering yesterday, I think that those are all pretty key points. But something is slowing me down here. Let's see here. Well, Ninja Trader doesn't seem all that bad in memory usage. Should close this workspace. We can get rid of that. We can get rid of that. Yeah. You get rid of that. Okay. Strategy analyzer. So my prediction for what I've written here so far is that it's going to be very unprofitable. So I'm only going to do the past 3 months to start. daily high low. Oh, could take some trades. So now I'm going to come over to our chart here and see if we get where we get some trades. Ah. Oh, no, that's interesting. That's, in fact, really interesting. Okay, so it is not doing what I thought it was going to do. It is not doing what I thought it was going to do. It's every time it's doing it. Oh, but you know what? It's on a 1 minute basis. So, yeah. So, how many trades did it take? 192. That's too many. Okay, but let's change it to a 5 minute. That's what we're really going to go for. Run. Okay, that's a little bit more like what I expected. It looks like you're stopping out like almost every time. I should have turned off the sound. Let's do that. No, I didn't say change it. I said X. There we go. Okay. Oops, not what I wanted. Okay. We're getting better at least. In fact, they all lost, but I'm doing 13. So when this was 0.25, it should be like half of that. It should be like 6, right? No. Okay, so let's just come back to the chart here and just kind of look here. That doesn't seem right to me. Wait, but didn't it come over here and say that like the loss ratio was basically like 100%? Percent profitable 0? But that's not what it's showing over here. Wait, that's weird. What the hell? Wait, that's okay. I'm doing something weird here. That's weird. Okay, so first of all, it's only doing they're both entering short, so that's one thing. I see. Enter long. Prior low is rising. should maybe get some long trades in here now at least. No. If, cross below. Yep. Close. Crosses below the prior low. Oh, okay. That would matter too. The stop loss and the targets here are wrong. Oh, that's weird. So is it setting the profit target to be negative? Okay, wait. Okay, so maybe that's what was causing the bug they were seeing. So I kind of got myself distracted and didn't do everything. So the stop loss should be the close of the bar plus, yeah, that should be plus. And then the target should be the close minus, yeah. So then these ones should be the opposite, right? This one we're going along, so the close minus this, and the target should be the close plus this, yes. Now in this time period, I should get both longs and shorts though. I think I should get both longs and shorts. So we'll see. Aha! Mucho better. Mucho better, yeah? Chart, rather. Okay, so yeah, there's a really great example. Breaches the previous day's low, and we try and buy it, but we get the stop loss. Here we get below the previous day's low, we buy it. In that particular instance, we made money. Yada, yada, yada. And then where's one where we get short? Okay, yeah, and here's one where we go short and we try and get the profit target. Now, I think that my stop and my R factor are probably a little bit too wide here because in this instance, that's getting the range is like, that's not 0.25, right? Summary point, yeah. I mean, if I came in and I had my stop be like 0.1 of the range, let's try that. Because this average winning and losing trade is like way too large. Okay, that's a little bit better. That's still negative, but the profit, the Sharpe ratio is better. Although it seems like that ends up making it take quite a bit more trades as well. Make the R factor be 0.5. Then we can do the stop be like 0.25. And then I guess this might be something that might be kind of, that actually didn't do much for us. Well, okay. So now, but I'm pretty confident when we come in here that it is doing the trade that we want, right? So waiting for the breach of the lows of the day, and then it tries buying it. Yeah. There might be some other filters that we put in, like, it should be a little bit further along in the day and stuff, but look at that. Now, that day it actually worked really, really well. That's pretty good. But then you're going to have days when it's like, well, no, this one is fine too. There are going to be some cases where you're going to get like some wild trends and it's just not going to work for you like that, right? Yeah, those are kind of ugly. But look, with the way that you know what? We're getting like 48% win rate with an equal risk reward. That's pretty good. It's pretty good. But, now it's time to come in and do some optimization, right? So we're just going to go by ones. I'm going to say the min is going to be 1 and the max is going to be like 16, let's say. 1, 16, 10% target. Let's see what that does. This is going to be a couple hundred iterations, right? 256, yeah. Cool. 2 and 10. And that's curious. I like this one the most, though. 6 period and a 3. Oh, there's actually pretty good over the time period. Can you discuss the platform and tools you're using to do this backtesting? Resolution on my end is not so good. Oh, I'm sorry. You might want to go and if you're on YouTube, you should be able to watch it in like 1080p. So you can go into your settings and change the quality. But you're looking at NinjaTrader 8, and this is the strategy analyzer. Sorry, but mommy's not up, so you need to stay in here. He just looks at me like, I don't understand why you're so mean to me. Just when you're looking at these results right here, just realize that's a 3-month period, okay? But I'm going to narrow in on that 6 and 3. 6 and 3. Okay. And now we're going to try and optimize the R factor. So I'm going to start at 0.5. I'm going to go as high as 5, and I'm going to increase by 0.5. And realize here that I am like very heavily fitting this. So when we expand it, it's very unlikely to work, but it should give us a pretty good base to start with. So I'm going to say 0.05, and we'll do the max being the whole range, and we'll increment it by 0.05. Okay. Wow. It did that really quickly. So, well, we actually did get we did get a Sharpe ratio over 0.5. So that's not terrible. 0.25 stop and 0.5 R factor. Huh. Okay. Oh, actually, no. You know what? Let's redo this. Optimize on Sharpe ratio. Okay. Can you see the puppy shadow on the wall from time to time? He's been doing stuff. Okay. Okay, this is a little bit better. Okay, but that it didn't change anything. If we come in here, I just want to check here on the optimization graph. If we say stop and R factor And the net profit, oh, that's really interesting. So you make the stop too big, it doesn't work very well. You make the R factor too high, it doesn't do very well. That's really curious. It might be better to be doing these like 0.2 stops. But it selected this spot right here. Well, whatever. Let's try it because it is the only one that has a Sharpe ratio over 0.5. Open in strategy analyzer tab. So when you look at that, you kind of have to think, hey, somebody trading this, they would probably feel pretty good, right? They would probably feel pretty good. But yeah, guess what? That's only 3 months. So let's go to 5 years. Let's go to January of 2017. Start there. And of course, remove this stupid fanfare. Run. What do you mean, what kind of auction system is NQ? Well. Yeah, it's interesting. So it basically did come out did kind of do what we thought it would. But I'm surprised at how close it was. I'm surprised that it's even close. There's some periods where it really catches some good ones. Right? And then some periods where it really catches a bunch of bad ones. It doesn't take that many trades though. Just kind of curious. Which is kind of curious. Hey, you know what? Let's go back over here. Let's do this. Let's do some more curve fitting. Because when we really overfitted it, it actually wasn't terrible. Or at least I could see why somebody would think that it's an effective way of doing things. You see the puppies, the shadow in the background. Puppy, you really shouldn't play with that light. Looking into the light is not good for your eyes. Why? What do you mean, why? Hmm. That's interesting. Very interesting. So if I would just want to go to a 1, R factor of 1. Let me redo that. Well, this was a system that somebody was quite full of themselves, um, believed very, very strongly in, and so we're kind of trying to show where the flaws are in this kind of a system. Okay, so you are able to get it to make money, right? So what was the stop point for? Yeah, 0.4 sounds fine. Makes sense. Like what we're seeing in the backtest results are exactly what I was saying in terms of, well, it's going to do well in certain time periods enough to fool him and make him full of himself, but it doesn't actually have very good results over a 5-year time period, even when we start to like curve fit it. Even when we go and we find historically the optimal parameters for it. No guarantee that those will work well into the future, but just on the past, they weren't that great. Like the Sharpe ratio that you're getting ain't very good. So in that one, the best Sharpe ratio came out to be the one that didn't take any trades. Okay, but did it come out? This one was kind of different because it was using a period of 5 and 6. Okay, but again, Sharpe ratio of 0.25. Although this might not be, there might be some problems with this just because when I say problems with this, I doubt this is exactly how he's trading it, because the way that he was trading it, it was doing well recently, right? And that change that we just made kind of changed that did better in 2020. Well, of course, everything did well in 2020. So that's what that's all about. But that's why I gotta tell you guys, Sharpe ratio is just like the first thing to look at, just because that tells you how well it's doing compared to the risk. Everybody just looks at that. They say, oh, it's positive. That's a good strategy. It's not. The only reason that it was making money is because it's holding for a decent amount of time. Like, look, average time in market, 335 minutes, right? So they're in for it's swinging. It's doing swings. And so the performance that you're getting is basically just the performance of the S&P 500. Now, the fact that both the long and the short trades are positive, that's good. That's good, but the Sharpe ratios are terrible. The Sharpe ratios are terrible. S&P 500 has gone crazy. I haven't heard any Okay, well, first Squawk is saying Ukraine and Russia have made significant progress on a tentative 15-point peace plan, including a ceasefire and Russian withdrawal if Kiev declares neutrality and accepts limits on its armed forces. Well, that would justify buying. That would justify buying. The earlier headlines that we had about peace, I don't think that really was doing it for me, because it was just kind of an offhand comment that I don't think was too significant. But this one, and of course, we would have to sort out the Federal Reserve and all that sort of stuff. But that's definitely sounds like something that makes me want to buy. You can see here the treasuries just crater down to the lows of the day. Jeez. I'm still not sure I want to trade this. Oh, man. That's being okay. So it's being reported by the Financial Times as well. Well, there might be a trade here, but it's going to be really hard to pick a price, right? Come here. Come here, you little gremlin. Come here, you little gremlin. I can tell. You want to play. This is a kind of a move that could continue. But there's going to be really massive liquidity holes. There's going to be like really deep pullbacks. So I don't know what to do. Oil is going to get hammered here, isn't it? They haven't even begun. I mean, the oil wasn't doing so good to begin with, but it's really going to start going crazy, huh? Question here is kind of like, where are the holes? Tough call. Not that much on the Treasury traded it, but like we've traded back and forth across this range twice now. Puppy's gonna cry at me for a little bit because I put him in the cage. By sentiment, do you mean that people are like it and living the good life now to will? No, well, by sentiment, I just mean there this morning. How do people feel? Do they want to take risk or do they not want to take risk? So the sentiment was positive coming in because of BS headlines. Now we really have optimism on a Ukraine deal, right? And if we come back to our chart, let's just remember here in the ES that, you know, this was when Ukraine was like straight up invaded. And all of this downturn was kind of like the run up to it. So, we're about where we were when that started. So yeah, if the market really truly believes, and I mean this is all kind of dependent on the headline really being the real deal, and we'll see if things get up further that it really is the real deal. So a lot of things could short circuit that, right? But if the market really believes this is the real deal, yeah, like I think that at least a short term reasonable round number to target would be like 4,400, right? Maybe not today, but that would be a pretty massive move for today. But now the question though is still, but the problem is we got the Federal Reserve meeting today. maybe it makes a really good setup for the treasuries. I don't know. Yeah, if no more war, if Kiev and Russia sign a peace deal that involves Ukraine keeping all of its territory, but that Ukraine that Russia is happy with, I think those are kind of like the preconditions for each side that Russia thinks it has security guarantees and Ukraine keeps its territory. Those are the things that the sides want, right? Um, then I think that the Western world would reverse all of its sanctions. Things would go back to where they were, and yeah, it would be very positive for the world economy. I mean, a lot of damage was done, hmm, but you can see the way that this is trading. Is kind of what I was saying. So the S&P 500 does appear to have found a bit of a liquidity hole at 44.34, and treasuries are reversing back quite a bit further than I anticipated. They're coming back to the VWAP right now. So, the Democrats are going to vote for a no-fly zone, and the Republicans will not. Putin has already accomplished his goals. After vote, Zelensky will have no choice to make the deal with Putin. Republicans, well, he's making a bunch of assumptions there. I'm not actually sure if they'll even vote on a no-fly zone for starters. I don't know if all the Democrats would actually vote in favor of a no-fly zone or not. I mean, come on, the no-fly zone would mean like World War III. I'm not so sure that Congress is actually going to do that. But if the Democrats were really hawkish enough to do that, I wouldn't doubt that there would be Republicans that would jump on. When you talk about a liquidity hole, are you talking about areas of high volume or low volume? Not exactly. They do end up being areas of high volume in the end, but what it really is it's an area of low latent liquidity. So what will happen is a large amount of volume will trade in that location really quickly, and that exhausts the latent liquidity in that location. It makes it more difficult for a price to move away from that location. So price will get stuck in that area, and then because it's there for so long, it does tend to end up becoming a high volume node. But it has nothing to do with it being a high volume node. It has to do with there being a liquidity hole there, right? So if we think that we're having a bullish run, what we should expect to happen is push up liquidity hole. And then once that liquidity hole has healed, they should be able to make a further push up. So where we're at right now is, this is kind of like the bear trap, right? So the bear trap is actually just a liquidity hole. So we were kind of watching for the liquidity hole. I think I misjudged it. We might still be okay. And I am still thinking or looking here for another leg, given that the piece of news that we had, although what I would say is still very tentative, the piece of news that we had is a very, very positive piece of news, right? So I think that we just kind of try to relax here. Guess we are going to get some oil numbers here. Well, man, I tell you what, if oil ends up being a build at all, they're going to get slaughtered. But let's see what the number is. Okay, so it's a build. This is going to be ugly. I do see the initial move in oil there to be down. They have to break like 95 before I can say it's anything significant. But So let's come back here. I guess I'll use Forex Live because they're the most recent one. I got to tell you, once you understand the liquidity holes and what causes them, the way that the market moves makes a lot more sense. Because the other thing that causes liquidity holes is just moving through an area very quickly, right? But it kind of leaves a wake behind it and kind of just makes the liquidity overall in the market less. And that kind of gives price this tendency to like mean revert or come back on itself. But then the market just reacts really strongly to like new orders. So it's kind of understand how you get the worst of both sides, right? Like most retail traders, we think of it as mean reverting or trending. So why is it that trending doesn't work? Well, because it leaves these liquidity holes behind him and price gets sucked back into it. But why doesn't it always trend? Because that's why it doesn't always trend. Why doesn't it always mean revert? Because the orders have a really significant impact on price. And, there's kind of random what those are going to be. There's not very much that you can use to predict which of the two is going to be because you would basically have to know the meta order and what's coming. The only way that you can really know that is if you know why they're trading it. In this case, we do, right? So we can make a reasonable assumption on how many orders are going to come in and buy it based off of this news. And the bet that I'm making is that there will be more. But we'll see. We'll see. This could, I gotta tell you, it's just so such a coincidence that this happens the same day as the Federal Reserve meeting, doesn't it? By the way, on this move back, because remember we had this big move up and now we're having this move back down. There hasn't been as many market sell orders on this move back down, even though we basically came back to where we were. So you're seeing the orders in the S&P 500, but not necessarily in the Treasury, which is a little concerning. It might be. Is that a real trade? It might be. I wouldn't think too hard about. I mean, I usually tell you guys when it's definitely a YOLO, not real trade, right? But I don't know how to present this from people. Everybody wants to focus on how well you've done, and I'm telling you, look at what the market does. To prove what the market does. Don't base your strategy off of whether Seth did well or not. Base your strategy off of what you can prove is true from empirical research. Doesn't that, I get it. That's the way people are wired. To look at people's authority and so forth, but like let's use science instead. That's what I'm trying to say. Seems like it's kind of a losing argument, or not a losing argument. Like, I mean, I know I'm right, but like it doesn't convince people very well, does it? But hey, if you want to, that's not what we're here for. We're here to make money, right? Okay, this is getting a little bit better there in the Treasury. S&P 500 still looks pretty bullish, but it's very much stuck in this rut at 43.34. Our liquidity and point of controls is no, not at all. So Willie, what I'm saying is a liquidity hole often turns into a point of control. But the thing that is funny is that the traditional auction market theory that people use to base, that they base this point of control stuff on and everything, the reason that they think the point of control is important is like the exact opposite of why a liquidity hole ends up being important. Science is not enough. Well, I think that here's why I say what I say. Because this is one of the logical fallacies that the market preys on, right? People a really good example. People tend to overvalue who is involved in a particular deal. Okay, so like a good example would be snow. Or maybe not snow, what's the other one? Datadog. Okay, so for instance, so both Snow and Datadog had famous names and invested in them. And so the markets really move, have really invested in those, where there are other companies that I think are better companies with better software that are completely ignored. Why? Because the market overvalues the name is behind it. And the reason the market overvalues that is because that makes the name more likely to be on the news, right? But it doesn't mean that the company is run better, right? So what really is that? The market is preying on a built-in fallacy that we use. It's a heuristic that in most instances is would be an effective way at looking at things. In a world where you're just trying to survive, watching somebody else that's really good at surviving right now tends to work out really well. Um, but that sort of strategy doesn't necessarily work well when it is a competitive market. When it's a competitive market, you're much better off looking for the things that everybody else overlooks. And so that's kind of where this becomes important, is that there's like real serious empirical research about the way that markets behave that retail traders completely ignore. And why do they completely ignore it? Because there isn't some guru on the internet with a huge pile of money pushing it, right? As soon as I, show you this huge wad of cash that I've made and start trying to promote it based off of that, it kind of ruins the whole thing, doesn't it? So I would much rather just keep to um, marketing it and appealing to the people that are going to go for it based off of the empirical evidence. And why is that? Because why do I want to do this? Why would I make a YouTube channel about it and everything? Because it helps me. Because it helps me develop better strategies. Because we work together to develop better strategies. So I don't want all of these morons that just go after, just chase the hot thing and are only see dollar signs in their eyes. I want the people that are interested in the science. Yeah. And that's why I don't use those kinds of strategies. I could probably make the channel bigger if I did that sort of a thing. But I'm not swinging big size here or anything either, so NFT morons, well, at least in the short term, the NFT morons have a lot of paper gains at least, huh? Well, market's still pretty stable here. S&P 500 did appear to have a little bit deeper of a pullback there, but they just snapped back to where they were. So a little difficult for me to really say when this will recover. It often takes like 30-45 minutes for it to go. So I'm kind of suspect that if this market does make another leg, that will be long gone when it happens. That's just unfortunate. I do kind of wish that I had kind of noticed when it was moving, although I don't know if I really would have taken the trade when that was happening. I just kind of I don't know. I went into okay, let's program in stuff mode just because I don't really want to take trades on FOMC day. But yeah, very very rare that you get a breaking news event as significant as that. If trading was your only income, then will you trade bigger size? If trading was my only income, I would have to have a pretty effing large account. And yeah, I would have to trade a certain amount of size. Okay, what was that? Hmm. Okay. I am now seeing. Okay, I got out. I just got out. I took a small loser. I lost like what, 2? Never really got very many favorable ticks on that one for whatever reason. But now the first squawk is tweeting Kiev rejects proposed neutrality in peace talks. So a headline has just come out that completely refutes that headline that we just got. I don't know about the treasuries here, but I think that could be good for a short-term fade in the let's just try it here. And this is like a really risky degenerate trade, okay? On a sim account. But I'm going to say 13. Probably, yeah. Because based on the orders and everything else, really good chance that we get to 42.90 here. 42.90. That was funny. You were fast, dude. I know, right? Well, as soon as I saw that move, I started looking at Twitter. It's like, okay. Okay, yeah, something's up. You know what though? Something that we see happen very very often in these kinds of situations is that you'll get a bunch of conflicting headlines, almost as and I really suspect manipulation in some of these instances. I don't know where First Squawk is getting this Kiev rejects proposed neutrality in peace talks. The other story was coming from the Financial Times, but it would make sense if Kiev disagreed with that notion that they would want to come out and nip that in the bud immediately, right? Tsunami warning issued after magnitude 6 earthquake off the northeast coast of Japan. NQ about this pattern. It is. This is a great application of what we know, right? We had a very strong quick move up. There is a big liquidity hold behind us. We have now had a piece of news. Well, then we had the post meta order impact, right? Now we've had a piece of news going the opposite way that is likely to cause all of those orders to reverse. Yeah, we're going to end up lower than where we started. In other words, we're probably going to go below 4,300. Probably going to go below 4,300. When you get news that conflicts that hard like that, yeah. Well, it was a good thing I got out of that trade, right? Because I was long from like 80. I'd be down $10 now. So I was, hey, I was slow on the draw on the first one anyways, but was maybe a good thing. Now the S&P 500, so far I'm not actually seeing the sell orders come in, and I think that one is I've only seen this from First Squawk. So if we start to see other squawks, push that as well. Okay, so now the Independent is tweeting it. Kiev rejects proposed neutrality in peace talks. And they have a story. Let's read the story. Nothing acceptable but solid security guarantees, says Kiev. Ukraine denied Russian claims that Kiev was open to adopting a model of neutrality comparable to Sweden in a peace deal. Russian negotiators said Ukraine offered to become a demilitarized state, but Kiev denied this and said Ukraine needed legally verified security guarantees to keep it safe and would not accept any other model. Earlier, Russian Foreign Minister Sergei Lavrov said security guarantees for Ukraine outside of NATO membership were being seriously discussed alongside neutrality. He said it was his view that certain solutions were close to an agreement. Okay, so I'm going to retweet this. Retweet. Are still not really seeing the S&P 500 react to this news. I guess the other thing that Okay, so here's another thing, is that the big move up that we had overnight was based on those headlines from earlier. So like, the whole overnight move kind of has to be questioned here at this point. And then you add that press conference, because the press, I am a little concerned that the FOMC press conference could be ultimately bad for the S&P 500. I mean, it depends on what he says, but it kind of seems to me like the markets and the equity markets in particular don't really understand what the Federal Reserve's current positions are. So, I think that you've got a lot of technicals and like momentum kind of moving against you, but this is going to move orders eventually. I think this could move lots of orders, so let's just kind of see. Only JPOW might surprise with his 0.25 hike would be a non-event. Yeah, if it was just like a 0.25 hike and he was like dovish in the press conference, I mean, that's the thing. It's really going to be the press conference that's the wild card here, right? Because we all know that they're going to hike 25 basis points. I'm seeing more and more people tweet this: Kiev has rejected neutrality and military limits. So this is a complete reversal of the news that, at least from our theories, the market was based on. There could be other things going on that are bullish for today, but, and it's been, how long has it been? 5 minutes? Yeah, it's been about more than 5 minutes since that counter news has hit the markets now, and the S&P 500 has not completely. I mean, they came back a little bit. They came back about 10 points, but they haven't completely puked. We have gotten more favorable excursion than unfavorable, though. And you know what? Our live trade, there was a loser, but it wasn't too bad. It's only only -2. It basically scratched it. I basically scratched it. And interesting. Last time we had a situation like this happen, it came back very, very quickly. But that's not happening in this case. So I think that there's got to be something I'm missing. That doesn't mean that the trade won't work out in the end, but I must be missing something. Yeah. I feel guilty. I ate too much candy. Well, you gonna stay up for the press conference? I tell you, this Federal Reserve press conference has the potential to be the wildest thing you've ever seen. Seriously. Has the potential to be the wildest thing you've ever seen. So I'm going to reset things here because this is the spot where the treasuries have kind of been hanging out for a while. As more reports about this earthquake hitting northern Japan, that's also something that could weigh on stocks. That's actually something that would weigh on stocks and bonds, is if giant Japanese insurance companies had to sell. I don't know how big of an earthquake is, how big of a tsunami it's actually going to be if it actually causes damage, but um, there is potential for that to be a market moving event as well. Set the alarm 3 hours from now. And yep, that's right. Yep. And just realize the press conference is 30 minutes after that. And then the press conference usually goes for at least an hour. Okay, so I am still seeing the volume come in short to the most part, at least. I like how those news move with no pullbacks. Yeah. Well, that especially the one that came in, around 8:10 or whatever, 10:10, depending on your time zone. That one really moved. Like that was before I even really realized what was happening, because we were backtesting stuff. Before we even realized what was happening, it had done its move, huh? Well, this is being so slow. I think that I'm going to try and market make a little bit here. All right. Hmm. Ooh, here's an idea. What if we made a volume profile of like all days, but instead of it being based on, the individual price, it was based on a percentage of the previous day's range. So if, the price would be at 100% of the previous day's range to be at the previous day's high, the previous day's low would be 0. And then if it's a negative number, that means that it was volume below the previous day's low. And then we had a volume profile of that, like every 1%. That would be interesting, don't you think? And then we could graph that. I think I will work on that, because that could be really interesting. That could tell us if there is more volume around certain places. Although I think that what the reality might be is that it spends so much time within the previous day's range that is going to outweigh how much volume is done on breaks. But you might see a fat tail distribution of some sort in it too. Okay. Well, it's about time for me to quit, so I don't think we get to see the resolution of this. I think there's still a really good possibility of the S&P 500 failing here. But I think that the order flow that we're getting kind of contradicts the overall theory so far, wouldn't you say? So I think we'd have to be a little careful about putting too much risk on for a trade here. The Treasury still kind of, I don't know. Kind of seems like for the Treasury to break a new low today, it would take a lot. But I tell you what, when the FOMC hits, it's probably any one of these prices are probably meaningless, right? Because even if there's absolutely nothing in it, you're probably going to see a really massive short-term move. So it's going to be a zoo today. But I think it's time for me to go. So let's say market reverses on war headlines. Rumors of peace deals reversed. That's what we're going to call it. Hey guys, thank you for stopping in. Make sure you come back in 3 hours for the FOMC meeting. You don't want to miss it, guys. You might you get an FOMC like this only a few times in your life, man. This is going to be a prehistoric one. Maybe nothing really all that great happens, but it's a pretty important moment for the market overall. So I will see you guys then. In the meantime, stay profitable, friends.